Challenging times bring out some of our most destructive instincts, whether it's personally or as investors. Step one, call them out. Step two, look for some of the anecdotes. That's what we'll tackle this week. So there's no doubt this is a challenging time. My wife and I had a challenging time of our own, trying to get our 6-year-old ready for first grade this morning. I know the feelings of these dark moments, those tough times can trigger in you. As I was talking about with my wife today, we can't control the feelings, the dark thoughts, the acts. We can't control what we actually do, how we can act out in a constructive, positive fashion to create the outcomes that we want to see. Happens in our personal lives. It certainly happens in the lives of investors. Today, I want to talk about 4 common destructive instincts we see come out during times like this, as well as 3 anecdotes that can help keep us on the path. Number 1 is this need to define, and particularly how emotional those definitions can make us. Things like bear market, bull market, recession. Right now, you'll see a lot of talk around the Fed, obviously, and interest rates and inflation. And coming back to, this likely means a recession. The yield curve's never been this bent since 1982. You should look up what happened from 1982 to 1991 for people who stayed the course. But the bigger point here is recession's probably already been here. A lot of this bad news is baked into this cake. This is why you see the market already down so much year to date. Be wary. Those definitions, again, and this is going to be point number 2, they narrow the path of your expectations when really what we need to be focused on is the destination. So this is point number 2, which is letting our feelings and what we want and how we want it to manifest disrupt us from our ultimate goal, i.e. focusing on the path instead of the point. There's a lot of ways to get to where you want to go. The thing that disrupts us is it doesn't happen exactly how we want it to. I was telling Matt about this in a different context earlier today with me. I know how it goes. You're like, man, this isn't how I played out. There's still a way to get to where you want to go, but you let that disrupt your mindset in such a way that it gets you off track. So you got to step back, calm things down, particularly at a time right now, just in case you think you're alone in this. This is the 3rd time period, 5th instance in history, 1990 and 2008-9 being the other 2, where bearish sentiment has crossed over the 60% number within the AAII survey. It is dark out there right now when you talk to people and their sentiment. And here's the bad news. In some of those instances, things got a little worse. So I can't come to you today and tell you this is the bottom. But what I can tell you is if you have a little bit of perspective, instead of looking 1 month, 3 months out, look 6 months, 12 months out. In both of those instances, the calendar year return the following year after that was up more than 20%. And the 6 and 12 months returns, respectively, on average, were between 19 and 33%. And so again, when it feels bad, this is what a bottoming out process, not a point, looks like, is usually about the time great opportunities are opening up. Point number 2, again, and then is this need to act or decide. Do I need to do something today? If that action that you're contemplating, as apparently a lot of people are, because $60 billion in assets across global markets left equity markets this week, is to bail out, that's just utter foolishness. It's what leads to, again, a lot of people not getting the returns, long-term returns of the asset classes they're in. It's very understandable from an emotional standpoint. It's absolutely proven to be destructive to helping you get to where you want to go. Rather, look at the dichotomy between acting and deciding. You can decide to do nothing. You can decide to stay the course. You can decide to look at opportunities to dollar cost average in or to rebalance certain parts of your portfolio that, again, are constructive but keep you on course and on plan. Which brings us to the 4th destructive point, the need to predict, which really is in everything. And you'll see this. So I'm just going to wait until it feels better. It's not. It's gonna, when we actually get to whatever the real bottom is, I can promise you it'll feel worse than today, and you're not going to have any feelings that tell you this is the perfect day to buy. What I would encourage you, again, for those of you who are in, stay the course. If you're not, if there's new cash that you need to get into the stock market, and I would remind you once again, there are a lot of things to buy right now we're excited about besides just stocks, pick a point, pick a date, and say 2 months from now, I'm going to move, because I know what those 6, 12, 24-month type returns look like, and I want to be a part of that. Anecdotes. Number one, plan. And you've heard me talk about this time and time again. Part of this is helping you define the destination so you even know where that needs to be to help you get off just focusing on the path that you're on. But the other important part is when you build out that plan and when we show clients their plan and we show them the different return series we expect, a lot of them are bad. There's bad years baked into the plan. You still can get to where you want to go. And I think when you can see it, it helps you believe it. And again, stay the course during challenging times like this. Second is perspective. One of the triggering things for people, again, the unexpected path is, hey, what is the average return for a portfolio? 7, 8%. You're never going to get 7, 8% in a calendar year. You can't let that trigger you. The chart that Matt's pulling up over my face right now shows you only get average about 5% of the time. 6 times in the last 96 years did you get something like an average return. Usually you're going to get something on an extreme that's going to trigger you to be more fearful or more greedy. Here's the good news, particularly for times right now. If you look at the far left, you'll see a bunch of years, 6, where the market dropped more than 20%. 2 of those follow-up years were during the beginnings of the Great Depression. The other 4, which would be far more analogous to where we're at today, were followed up by years with an over 20% gain. I.e., it is, as an investor, usually darkest right before the dawn, but that dawn does inevitably come. The third is probabilities. I hear a lot of people say, isn't the Fed going to keep raising rates? Couldn't things get a little bit worse from an economic data standpoint? I think that is quite possible. The important thing to know is it's largely expected at this point. The Fed overhiking, creating a deeper recession, largely baked into the expectations of investors. And why this is so critical is markets move in relative ways. They're going to move relative to expectations. And right now, expectations, as I just quoted you with some of those sentiment surveys, couldn't be historically a whole lot worse than they are right now. In summary, pulling this together, the 2 big dangers, if I was going to sum all this up, is again, thinking something along the lines of this time it's different or somehow I'm different. I'm going to set a course. I'm going to break the stat. I'm going to be the exception to the rule. Can it happen? Sure. Can it happen consistently? I haven't seen it. But again, following those truths, having a plan, keeping your perspective, understanding the probabilities of the market can keep you on course and again, help you reach that destination regardless of the path we have to take to get there. Thanks so much.